With the averages taking another big hit today, exactly how worried should we be? Now, I've been warning you that this market would get a lot more difficult for a whole host of stocks since late November. But what do we do now that they keep rolling over? Whenever we arrive at a highly emotional situation like this sell-off, you always want to take your feelings out of the equation. And that's why I like to fall back on a more quantitative, empirical approach. So tonight we're going off the charts with the help of Mark Sebastian. Now, he is a brilliant technician who's the founder of OptionPit.com, and he's our resident volatility expert. And the name of the game right now, of course, is volatility. In the middle of last week, the CBOE Volatility Index, also known as the VIX for short, or the fear gauge, if you want to be more evocative, stood at 17. 17. Today, it's at 29. Like I told you last night, yesterday's late afternoon breakdown was absolutely terrifying. Market lured you in with a strong opening and then steamrolled you if you were foolish enough to take the bait. Then we got another ugly session today. So how do we interpret all of this pain? According to Mark Sebastian, there are two types of situations where the VIX explodes higher. You've got the volatility spikes and the volatility swells. Now, if you're bull, you'd much rather go through a spike. That's the short-term pop in volatility, where the stock market sells off swiftly over the course of a few days, and we've had a few of those spikes in the last year. The worst of them took place in mid-September through early October as we were coming to grips with the Delta variant. How about volatility swells, though? Okay. In a volatility swell, the VIX rises for an extended period of time, maybe 2 to 6 weeks, and the stock market experiences a genuine correction. In Sebastian's eyes, we haven't seen a serious volatility swell since 2020, or at least we had, because we're certainly seeing one now. I want you to take a look at the pair of daily charts, the S&P 500 on top with the volatility index on the bottom, going back over the last 12 months. You can spot more than a half dozen volatility spikes here, where the VIX briefly shot higher, then the market sold off, and then the S&P went back into rally mode not long after. According to Sebastian, this current move is different. The VIX didn't just explode higher out of the blue. It's not a spike. It's a swell. And swells are ugly, as you can see from the next chart. When we zoom in on the S&P and the VIX just back through November. As Sebastian points out, ever since the S&P 500 topped out on Jan 3rd, the VIX has been slowly but steadily marching higher. It hasn't made any giant single-day moves, but it rallied relentlessly for the last 3 weeks. In other words, no spike there. According to Sebastian, this is actually bad news for the stock market. What does it mean when the VIX steadily moves higher? Okay, the VIX measures the implied volatility of S&P 500 options. So when it rises like this, it means that traders have been buying protection for themselves every time the VIX tries to back off. Even on days when the market manages to rally, they don't move to unwind these hedges. They buy more insurance. Remember, rule number one, volatility index is that it's supposed to go down when the market goes up, and it goes up when the market goes down. Very strong negative correlation here. However, when that correlation breaks down, it tells you there's something wrong with the action. Now, just look at what happened with the S&P 500 and the VIX yesterday. Very short term, just the hours. Even when the market was booming in the morning, remember we had that really horrible up opening, the volatility index didn't really drop very much. While the S&P was up 1.5%, the VIX only dropped a touch over 2 points, which is barely worth noting. As the S&P stayed up nearly 1.5% for several hours, Sebastian says you would normally expect traders to sell their long put options, right? Which would push the VIX significantly lower, right? Market goes up, VIX should go down. In fact, around 11, the VIX started to rally, even as the S&P stayed in place. Bad sign. Sure enough, when the market started to plunge, the VIX was off to the races. In Sebastian's view, that's a clear sign that the decline was right and the earlier rally was misleading. And that's not all. I want you to take a look at this chart of the VIX futures. Remember, this index is based off option prices, and options expire every month. So you can bet on an April volatility or May volatility or June volatility with the futures. Unfortunately, the VIX futures have started to move into what's known as a state of backwardation. In other words, the current volatility index is trading at a premium to the February VIX futures, and the February futures are starting to move above the March futures. According to Sebastian, when the VIX futures go into backwardation, it's a sign of the market becoming irrational. It's often a turning point for the stock market. It can mean we're about to reach a significant bottom and that the averages can turn around, something that the oversold condition would indicate, but it can also mark the beginning of a hideous breakout. Sebastian points out that the VIX futures went into backwardation in March of 2020 and stayed that way for weeks. Same thing happened in October of 2018. Federal Reserve crushed the stock market with a series of aggressive rate hikes, and Jay Powell talked about the need to overshoot in order to stamp out inflation. In short, pretty much every time the market sells off dramatically, Sebastian says the VIX futures tend to go into backwardation about a third of the way through the devastation. Then the selling continues for a few more weeks. Unfortunately, that's where he thinks we are right now. because we're not dealing with a VIX spike. We're dealing with a VIX swell. And those always last longer than you'd like. The bottom line, the charts as interpreted by Mark Sebastian suggests that the S&P 500 can remain the house of pain through early February. Now, I wouldn't be surprised if he's right, but as the market gets hit, you need to hold your nose and use this weakness to buy the stocks of quality companies that make real products or provide real services and generate real profits, like we started to do today for the Charitable Trust, as you saw, if you remember the club and watched our morning meeting show. Everything else, ice it. Let's go to Johans in Texas. Johans.
Yes, good afternoon, Jim. Thank you so much for taking my call.
Of course.
Long-time listener and subscriber. Back in September, I bought into the buy now, pay later trend and took a position in the firm hold. You said I've watched it just get beaten down. What is your advice?
Okay, you're banking with Max Levchin, and I think Max is a brilliant man, and I think you just got to hold it. Max will figure out a way to make money. That's what he's done all his career, and you can work with him to do that. And I think, I'm not saying shut your eyes to anything. I'm saying that Max Levchin's a moneymaker, and he's going to help you out of what looks like a wilderness right now. Let's go to Timothy in Texas, please. Timothy.
Hey, how you doing, Jim?
I'm doing well. How about you?
Well, I got COVID, but
I'm sorry, man.
I'm okay. I've got the boosters, so I'm
all
good.
Right.
My stock is I bought this stock in November as a speculative. It had LiDAR tech. I was kind of interested into.
Okay.
The stock is Lumina. I got in at about 1945, and it's just been down to $13.
Right.
$13 range. They had $300 million buyback. They've been granted their patents, and they got deals with Volvo and Mercedes. I was just wondering if I can't hold on to this.
I cannot be encouraging, if only just because I have been, ever since November, a believer that if a company is in pre-revenue or not making any money or losing a lot of money and doesn't have anything that is, say, a product that people want, that everybody wants, consumer product, it's not going to work. And not going to work is really just code for it's going to go lower. So I wish I could be encouraging, but I've left that train in the station. All right, the charts as interpreted by Mark Sebastian suggest that selling the S&P 500 could continue through early February. Against that is the oscillator I use, which say we should start buying, and the negativity, which tells me that you'd be wrong not to pick away at good things. If the charts are right, though, I suggest using that weakness to buy high-quality companies. That's why I can't recommend a LiDAR play. I can't recommend a battery play. I have to recommend real companies here with real profits and real goods. Much more Mad Money ahead. Whenever you call in and stump me on a stock, I put in the work and report back with my thoughts. Tonight, we're tackling two of those stocks. And then Netflix investors are not chill today after earnings, not like Jimmy Chill. And I'm sharing what else beyond the headline numbers is impacting the stocks. And, of course, all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer.